Welcome to the Radix Review. Tune in each week as co-hosts Jay Denton and Chris Nebenzal cover the key trends in the apartment industry, macroeconomy, and much more. Hello and welcome, everyone. Today is July 18th. We are back with another episode of the Radix Review. Jay, what are we seeing in the market this week?
Chris, you're going to let us know about the latest weekly numbers from the rent and occupancy trends report that you produce each week. I'm taking a deeper dive into Texas. I have a presentation this week specifically focused on the big four Texas markets. So we're going to get into a lot more detail than we normally do on markets, but I know there are a lot of people from Texas that tune in, big multifamily markets. So we'll go a little bit deeper on that. And then the latest CPI numbers and any sort of influence that might have on rate cuts, which we keep talking about because we're waiting on that first one to happen. So Chris, why don't we go ahead and jump into it? Give us a recap of the latest numbers in multifamily.
Sure. So this week we started to see a little bit of deterioration in the multifamily metrics that we're tracking across our rent and operating trends report. Certainly traffic and leasing, those are the leading indicators. Those slow down first. And we have started to see the slowdown there. It's interesting because, Jay, we have talked a lot about the third quarter being the plateau quarter where things just kind of stabilize, things stay pretty steady. But the fact that we're starting to see traffic and leasing start to fall off, this gives me a little bit of concern, not necessarily a giant red flag warning, but a little bit of concern for the second half of the year. So last week, we only saw 3 markets where traffic improved week over week. They were all small southeastern markets. Huntsville, Columbia, South Carolina, and Charleston were the only 3 markets that measured any traffic growth week over week. There were a handful that were flat, about 7 markets were flat, but 35 markets saw traffic declines last week. And interestingly enough, they were led by the Southeast as well. Miami lost about a full tour per property. Greenville, South Carolina, a half tour. Tampa, Orlando, Wilmington, North Carolina, all saw pretty significant traffic declines last week. So something that we'll keep our eye on. Again, the third quarter is typically the quarter where we see leveling off of metrics. Things kind of flatline, occupancy stays stable, rent growth stabilizes, and then things decline in the fourth quarter. But if we continue to see this kind of quick deterioration, that might be a bit of an ominous sign for the rest of the year. Certainly, we saw a pretty strong first half of the year. We just wrote about it in our mid-year review. But if we start to see these metrics shift very quickly, that could be an indication of more weakness than we were expecting. Rent and occupancy also declined a little bit. Now, again, I'm not worried about a few basis points in occupancy. I'm not worried about a 10 basis point dip in rent here and there. But, rents did drop below $1,800 on average nationwide. Occupancy is back under 94%. We're starting to see some pretty significant declines, even in markets that were performing well. Reno, occupancy was off 10 basis points last week alone. Wilmington, Huntsville, our last 2 markets of the month, both lost 9 basis points of occupancy last week. So again, yellow warning flags, not kind of the super dark clouds on the horizon. I know I'm mixing metaphors here, but overall, starting to slow on the rent and operating trends report. Nothing overly concerning, but we are starting to see a little bit of a slowdown. Certainly something that we'll cover in our reports every week. Certainly something that you and I will continue to talk about as we move through the summer. But early warning signs starting to pop up. So I didn't mention any of the Texas markets, Jay. I know you are headed down to San Antonio tomorrow. What can you tell us about the big 4 markets in Texas?
Yeah, and a quick comment on what you just covered as well before I take the deeper dive into Texas. This is something that we've talked about. We've talked about it all year with clients that, hey, it's been a pretty decent first half of the year. And the second half of the year, just know that typically things are going to slow down. I think what will be curious to watch, and what we'll likely be covering on future podcasts, from what I saw in the numbers, last year there was more, if you call it seasonality, a bigger decline than typically you would have. So occupancy slipped a bit more, rent slipped a bit more. Now we know that was a combo of both decelerating job growth and an increase in the amount of new supply. So what'll be curious is if it's another one of those rougher than normal back halves of the year, or will it start to look a little bit more similar? And if it would just be a normal, kind of third and fourth quarter, I think things would be okay. that's where we'll see specifically in some markets that have had a bit rougher time. Those are the ones that we'll obviously be watching and reporting to everyone that's attending our presentations, listening to podcasts, and so on. Texas markets, yes. So I'll be covering with a group that manages and all the four major Texas markets. And so we'll be getting a little bit deeper in the stats over the next couple of days with them. You mentioned traffic overall and how traffic, at a national level is starting to come down from the peak. I'd say looking at the four Texas markets, we see very similar trends to what we see for the U.S. total in terms of how much traffic has been off from past years. So most of the Texas markets, so I'm talking about Austin, DFW, Houston, San Antonio, traffic counts typically down 10 to 15%. Now that only might be 1 to 1.5 tours per week. But again, when you think about it on a percentage basis, 10, 15% makes a significant difference in the amount of people, walking through the door to tour the units. And so little concerning, but again, we know renewal rates are up. And so I think that helps and is one of the reasons traffic might be down a little bit because people are staying put, but see very similar metrics there. Some of the rest, so demand, overall demand, Texas, obviously known for demand. If you look at population growth, it's something that I'll talk about during this presentation. So the U.S. total from 2020 to 2023, so over that 3-year span, the U.S. added 3.4 million people. Of that 3.4 million people, 2/3 of them went to either Texas or Florida. And Texas made up the largest share, 1.3 million of the 3.4, but still just 2 states had 2/3 of the population gain, and the other 48 split the rest. Now it doesn't, so that it might seem a little bit weird. You had some, states like California, Illinois, New York that lost a lot of population. So past Texas and Florida, Georgia still added a lot. Arizona did, the Carolinas, and so on. But still, just to see those 2 states dominate. But obviously, Texas, the biggest player there with the biggest population gain over the last 3 years. That's why the supply is being built. To if not, people can't move here, and because there's nowhere necessary to live. Of course, occupancy rates aren't 100%, but we need more supply, obviously, for the amount of people, the amount of jobs being added, and so on. Speaking of jobs, Texas is still adding jobs. It's still up there in terms of whether we look at relative or absolute job gain or growth totals. But Dallas and Austin specifically adding far less than they normally would during a period of economic expansion. So as an example, Dallas, Fort Worth right now on a relative basis growing right at the same as the national level. So right at about 1.6% job growth year over year. It's average. Dallas isn't used to being average when it comes to job growth. That's why, again, we tend to lead or be up there in terms of the top of the amount of supply being built because of the number of new jobs, the number of people moving here, and so on. So usually Dallas would have about double that amount. If you look at the 5 years prior to the pandemic, it had almost double the job growth as what we're experiencing right now. Very similar story for Austin. So Austin, I believe, is just a little bit above 2% job growth. It'd normally be closer to 4%. And so that's why these markets, while even though they're up there in terms of the job leader category on a relative scale, especially compared to the amount of supply coming online, they're just not keeping up, and we're seeing that in the performance. Houston, on that scale, in terms of overall job growth, Houston and San Antonio faring a little bit better and a bit, basically right around the 5 or so years before the pandemic in terms of what they're doing in terms of jobs. The last part I thought I would get into is just the performance itself, and then breaking it down a little bit deeper than just the overall market level. I looked at property quality score, or what people might call asset class, so class A, B, C. With class A, you're typically talking about fairly newer buildings, often mid-rise or high-rise, some of the higher rent levels in the market, and so on. Class B is something in the middle. Class C tends to have some of your lower rents in the market, older properties, and so on. So a few things that stood out. If I look at Austin, I think this is a promising sign. Obviously, a long ways to go, but Class A occupancy in Austin has been steady since November of last year. So not having a good seasonal increase like you would expect during the second quarter and heading into the third, but at least holding steady given the amount of supply that's hit. The bad news is across all asset classes, rents are down roughly 8%. So still a ways to go there in terms of a recovery, but it's good to see that at least those units are being absorbed and the Class A is able to hold steady. In Dallas, Similar kind of story. Class A and B occupancies are around 93%. Class C is actually a little bit lower here in Dallas, as it tends to be across Austin and San Antonio as well. Class C tends to hold a little bit lower occupancy rate. In Dallas, Class A and B rents are down about 4%. C is doing a little bit better, down 2. Houston, it's really the best of the four. I know it's one that you have talked about, you've written about, and so on. Class B rents are actually flat. So if you're that middle of market price in Houston, we show rents are actually right about the same as they were this time last year. And Class A is only down 1%. It's really, Chris, it's like this. When we look at these markets, and you kind of have three different categories. You have the ones that looks like they've recovered, they're past it. You have the ones right in the middle. So you're seeing the really good signs. Houston's in that category where it's just on the brink of being in that other set of classes, I think, where it's back to kind of getting closer to normal. And then you have the ones like in Austin or Dallas. It's got a little bit longer road ahead of them, but we do believe, going into next year, as long as job growth, as long as the economy can hold, a more favorable year next year for operators in 2025. And then I'll just wrap up with the city that I'm driving to, San Antonio. There, I would say A's seem to have been hit the hardest. Again, each one of these, it's a slightly different story. There, it looks like A's have been hit the hardest. Rents are down about 6% year over year. Whereas, again, if you're at that more affordable end of the price range that some people might call Class C, rents are actually flat year over year. So about the same as they were this time last year. So I know that's a pretty deep dive, deeper than we usually go in a lot of these markets. But as I mentioned, Texas, big multifamily market, and ready to see some of my favorite metros, the ones that I live around, bounce back.
Yeah, absolutely. And it's a great point about Houston. Houston has long been a market that perpetually oversupplied, even though the demand has been strong. I think whether it's the developers, whether it's the local zoning and planning entities, they've finally got that balance right. Excuse me. They've finally struck the right amount of new supply for the demand. And as a result, the performance doesn't lie. You're seeing Houston outperform even its Texas peer markets, which usually does not happen, especially, over the past 10, 15 years. So yeah, good performance coming out of Houston. And like you said, I think Austin and Dallas are on the road to recovery, but it will take some time.
Yeah, I think the other point, specifically to Houston, because I've seen this throughout my career tracking multifamily, and people kind of lump all of Texas as one thing. And actually, if you look at Houston, oftentimes it will perform counter the other markets because of what's happening in oil and gas can be different sometimes than what's happening in the overall economy. So like if you go back to that kind of, I think it was 2015, 2016, 17 era where the oil prices were really being impacted, Houston was down where the other markets were doing quite well. That caused supply to pull back in Houston where building kept occurring elsewhere. And so because of that, I think you can even go back to the 80s and you can see similar type things where sometimes because of that industry concentration, and yes, it's more diversified than it used to be, but look, the energy sector has a big impact on that market, and it doesn't always run the same as everything else in the U.S.
Yeah, that's a great point. And even if you wanted to take it one step further, Midland is a market we track, and that's probably the most oil concentrated market in the country. That has been one of the best performing markets. So certainly as oil has been, the price of oil has stayed high in the $70 to $80 a barrel range. We're still pumping a lot of oil. That's beneficial not just for a market like Midland, but it has downstream effects certainly for Houston as well. So Jay, we saw the CPI numbers come out last week. We also saw Jerome Powell testify before Congress. What did you see in the CPI? Any indications on rate cuts or anything you can read into monetary policy from some of the recent news?
I think if you look at multiple indicators, you're seeing them kind of flatten or slow, getting closer to the Fed's target rate. So CPI tick down just a little bit more. I think the housing component within CPI is finally starting to moderate. If you look at wage growth numbers that are being reported, wage growth keeps moderating, or it's down just a little bit from what it's been. So I think it seems like there are very favorable numbers. Same thing with the job numbers that we've talked about. The reports keep being strong, but downward revisions to past months. So it does seem like overall things are cooling down. This is something that we've been watching and we've been expecting that maybe there could be a rate cut. Let's say in September. July felt a little bit early. There was a Wall Street Journal economist survey that we certainly tune into every quarter when it's released. And they keep thinking that the next rate is just, we're on the precipice of it. It's about to happen. I think the feeling is really that it's getting closer and closer. We'll dive more into some of the specifics on that survey, I think, on the next podcast. But the one thing I would note from this one is 64% of economists that were surveyed believe that the next rate cut would happen in September. And signs are starting to point towards that could be the case. But again, we'll see. We keep being surprised by it being extended.
Yeah, and I agree. I know I'm not surveyed. You're not surveyed in that Wall Street Journal economist survey. But if they were to ask me, and again, I also don't have a direct line to Powell and the Fed, but the Fed does love to be transparent. They love to be able to very clearly lay out their moves. And so what you saw with CPI this month, we actually saw month over month disinflation for the first time since 2020, since right at the beginning of COVID, where prices went down actually month to month, and that annual number came back to 3%. What I think will happen is the Fed will outline a rate cut for September in their July meeting, in their July statement. They've also got the Jackson Hole Symposium. They'll talk again at the end of August. So that way they can kind of really lay out to the market, look, we're going to cut in September. We're going to cut in September. It's not going to be November. It's not going to be politically charged one way or the other. So again, I know nothing's set in stone, but that would be my prediction at this point. We'll see one cut in September. We'll see some more data through the third and fourth quarter, but we might even see another cut in December as well if things stay soft. So certainly something to keep our eye on in that front. So Jay, we'll wrap up with a wild card. I know you're headed to Texas. We talked a lot about Texas. I've had kind of a long-term thought or a long-term theory that, that I-35 corridor from really Sherman or the Oklahoma border down through San Antonio will eventually look like the I-95 corridor from Boston all the way to DC, with continuous development all along the corridor. So I've got a bit of a challenge for you. I guess first and foremost, I would say keep your eyes on the road, stay safe. But while you're doing that, I want you to try to count and visualize the number of kind of open farmland you see compared to the number of cranes you see. And not just cranes like multifamily cranes, we track that, but what else is being developed? Hospitals, schools, office buildings, infrastructure. Fill me in and perhaps even share your thoughts now, but fill me in on future podcasts on what you're seeing in that corridor. I drove from Dallas to Austin a couple months ago, and in and around Waco, you're seeing the expansion. Certainly north of Austin, that market has stretched to the north. But would love to challenge you to keep your eyes out for the number of cranes, perhaps versus the number of cows, because a couple of years ago it would have been cow dominated, and I think that might have switched. But that's your challenge for the week or for the few days in front. But first and foremost, stay safe as you drive down.
Yeah, thanks. Funny you mentioned Sherman. Most people have no clue what market that is. I actually grew up right next to Sherman in a little small town, so I'm very familiar with from that drive all the way down through Texas, all sorts of which ways. But it's always amazed me whether I go north, so Frisco, which was a tiny little town when I was growing up, and Prosper, which was even smaller, just where they are today. In our industry, I know when we go to these different places, we always see apartments. We see them more than other people, it seems like. And so you start to notice, especially places that used to be these little small towns, and now they have mid-rise, sometimes mixed use apartments. And it just seems amazing to me, just the growth that we're seeing in the state. So I'll try to keep count the best I can on the way down there. I'm sure that I'll see plenty. It amazes me just how large the state is. When I lived in North Carolina, I could, drive 4 or 5 hours and be in multiple different states, just depending on which direction I went. And here, I could have been down to Atlanta or up to DC in the same time I can go to San Antonio or Austin or Houston, or even out west to Lubbock or somewhere else. And so, yeah, it just seems like the roads get more and more crowded. And so hopefully I'll get down there without any sort of issues.
Sounds good. Well, enjoy your time down in San Antonio. Good luck with the presentation. Thanks to all for listening to this week's edition of the Radix Review. Please rate and review our podcast on Apple or Spotify, and we appreciate your continued support. Thanks again for listening.